Greetings and thank you for joining us for this video edition of In the Loop brought to you by Alphen Insurance Agency. Today we're going to dive in and talk about whole farm revenue protection policies. Whole farm revenue protection provides a risk management safety net for all commodities on the farm under one insurance policy. This insurance plan is tailored for any farm with up to $17 million in insured revenue, including farms with specialty or organic commodities, both crops and livestock, or those marketing to local, regional, farm identity preserved, specialty, or direct markets. When you look at whole farm revenue protection, we have to remember this is protecting your total revenue stream for the year. It provides you against loss of insured revenue due to unavoidable natural causes of loss that occur during the insurance period. Now, one thing to note, your crops like corn, soybeans, cotton that have regular MPCI coverage are still covered for loss under the MPCI. However, any indemnities from those crops insurance policies count towards your total revenue for the year on your whole farm revenue protection policy. When it comes time to apply for a whole farm revenue policy, some things you need to provide are 5 years consecutive Schedule F line number 2s from your federal tax return to show your revenue from your farming operation for those 5 years. The second thing you would need is expected revenue by crop for the upcoming year. In the chart down below, I did a sample farm here that was mixed with cattle sales, corn, cotton, cucumbers, soybeans, strawberries, sweet potatoes, flue-cured tobacco, and wheat. What you do, you plug in your acres, your projected yield per acre from your APH history, the projected price from whatever we think the market's going to be, insurance price wise, or any contracts you may have, to give you your total projected income. In this example, $2,700,000 is their pre-season application time projected income. Now we'll come back after acres reporting. We'll update these acres and numbers, and then at the end of the year, after you've harvested and sold your crop, we'll do the final calculations to see where things end up on your policy. You may ask, what else do I get from this type policy? If you'll look on this example here, this shows that you get replant protection with your whole farm policy. Down at the bottom, corn and soybeans are excluded because with them having MPCI replant protection, you can already get an indemnity there if you need to replant. The unique thing about this, crops that are common in our area, cotton, cucumbers, wheat, sweet potatoes, some of these things that don't have standalone replant policies, replant coverage, get that from the whole farm revenue protection policy. On the example here, you'll see at 80%. That's just showing the coverage level of the whole farm revenue protection for this example. The 20% out to the side is calculated from, if you remember on the prior chart, we looked at expected revenue for the upcoming crop year. That would be 20% of expected revenue for this example came out to $3,751 was their expected revenue. You're looking at 20% of that being $600 that they could use per acre for replants. Now, if $600 was your expected replant for that, but you could only provide $400 worth of expense, $400 is the only replant coverage you would get per acre on this policy. Now, a unique thing about it, like with tobacco and sweet potatoes, does not have to be a square acre replanted at one time. You can do plant counts, keep up with those, go in and peg plants as needed, and when that total count reaches a 1 acre value, You can submit those expenses in up to a maximum of your coverage for replant per acre. And if you have valid expenses there, you'll get your coverage on that. As with all replants, they're subject to approval by the adjuster and the AIP, and the rules are subject to the 2020 rule and other rules that RMA or the AIP may impose on this policy. Next, you may ask, is it subsidized like my MPCI coverage? Whole farm revenue protection is very highly subsidized. If you look here in the circle, you'll see from 55% coverage level to 75%, there's an 80% subsidy that kicks in on this policy. That's extremely good coverage there, and it really greatly reduces your premium amount for this type of coverage. You'll notice on the left, qualifying commodity count at 2. This thing's going to max out at 75% coverage level here. If you've got 3 commodities, you're going to get up to 85% coverage and still maintain some subsidy at that 80 and 85% coverage. Now, when we go into the system and start entering this into a quote, you'll see where all the numbers I talked about earlier start to fall into place. On the left, you'll see the expected revenue by crop. In the center, you'll see your Schedule F for the last 5 years that fall into there. And on the far right, you'll see your MPCI liability. And you'll ask, why is that important? Well, when you have coverage from MPCI for some of the crops, that helps reduce the risk because you've got additional income protection and liability on those crops you have MPCI with, which helps lower your rate for your whole farm revenue protection coverage there. We'll continue on, and you'll see in yellow some of the options you can purchase with this policy, which are very similar to options you can add on to your MPCI coverage. The one in the middle there, Revenue Cup in yellow, limits decreases in historic average revenue up to 90% of the prior year's approved revenue. Second one we'll look at, Revenue Substitution, substitutes low historical revenues with 60% of the historical average. Third one on the next page here, Revenue Exclusion, excludes the lowest historical revenue. This is a pretty good option to check if you're going to look into this, to be able to kick out that lowest historical revenue out of your 5 year. That can greatly change your average of revenue on those 5 years and allow you to get a little more coverage. And we talked earlier about 70% coverage. That's going to guarantee, based on this operation here, $1,890,000 of coverage for a premium of $12,096. We're going to back up here a couple pages. Expected revenue for that year was $2,700,000. When you look at their historic average, $2,877,000. And again, we're buying 70% coverage on that, would put us at a guaranteed $1,890,000. If we went all the way up to the $85,000, you could guarantee revenue $2,295,000. But you'll notice the difference here in premium goes from $12,000 up to almost $45,000, going from 70 to 85%. Takes us back to this slide here. Shows how much the subsidy starts to drop off once you get to that 80 and 85% coverage. But to let you know that coverage is there, we show you this on the example. Lenders really like this type of policy because it does provide total revenue protection there, and you buy a percentage of that up. Some of the lenders will require you to get up to the 80% level there on that, maybe even some up to 85. But it does provide them a peace of mind that helps guarantee your operating loans for the year that you may have with them. That was a short version of explaining whole farm revenue protection. And if you have any questions or you think you might have interest in this at your farm, give us a call. One of the team members from AIA be glad to go out and meet with you, kind of help look over your tax records with you, work up your projected income for the following year, and get you a quote put together to let you know kind of what this would cost and let you make the final decision on if it's something you'd like to add to your operation. Thanks again for tuning in today. We look forward to talking to you again on a future edition of In the Loop in video. And we hope you have a good day. And as always, we appreciate the opportunity to do business with you. And if you'll give us a call, we'll go to you so you can focus on your family and farming. Have a good day.